Everyone, and welcome. Thank you for joining us today for our summer 2026 Canadian Energy Market Outlook. I'm Greg Garnsey, Sales Manager of Western Canada, and I'll be your moderator for the webinar. Joining us today is John DeYoung, Load Analytics and Meteorology, Joshua Woloschuk, Director, Natural Gas Fuels Emissions Fundamentals, Greg Billingsley, Manager, Canada Power Trading, and Isaac Lurie, Manager, Strategic Client Services. I will not read through all of this, but in summary, the purpose of today's presentation is to provide information for informational purposes only. Please consult with your own advisors before acting on any information contained herein. Our agenda today includes a weather update from our meteorologist, John, who will consider the weather models for the summer and let us know how the shift to El Nino weather pattern is shaping up. Next, Josh will cover the natural gas supply demand fundamentals, pricing impacts, and a snapshot on recent geopolitical events, along with LNG development in Canada and North America. Then Greg will review our electricity markets in Alberta with an update on the restructured energy market and its potential price impacts in Alberta. And then we'll look at in Ontario pricing since their market redesign last year, and also a look at nuclear outages and pricing going forward in Ontario. Then to close us off, Isaac Lurie, our client strategist, will help pull it all together, pull all the current market info together, and help you consider purchasing strategies for both electricity and gas, and how to avoid the surprises to your energy budget. He'll provide a quick review of how the various price plans may fit with your risk tolerances and budgetary goals. Isaac and our account executive team can help you navigate the market and your options. So now I'll turn it over to John DeYoung to get us started with the weather.
Yeah, thanks, Greg. As Greg said, my name is John DeYoung. I'm the manager of Load Analytics Meteorology here at Direct Energy NRG, and we're going to take a look. We're going to do the usual thing, the usual suspects. We're going to take a look at what's happened the last couple of seasons, kind of get into El Nino, and take a look at where we are and where we're headed. Take a look at some climate models, climate trends, and then kind of end it looking at some of the government forecasts for this upcoming summer. So starting off, taking a look at this last summer, a little bit U.S. centric. The statistics for population weighted CDDs and gas weighted HDDs are a little more accessible on the U.S. side of things. So we'll see a lot of U.S. centric statistics those next few slides. But for the U.S. last summer, it was the 10th warmest since 1950 at 995 population weighted CDDs. On the whole, the Rockies, both Canada and through the U.S. were warm. We also saw pretty warm Tennessee Valley, Great Lakes, Southern Ontario, Quebec. But there was a little bit more, a divide, if you will, between the months. When you break it down, June and July kind of followed that same composite look, but August was quite a bit different in the eastern part of the continent. We saw an upper level trough develop early in the month and then kind of hold through most of the month. And we ended up with relatively cool in the U.S. Ended up probably near-ish normal for the main populated areas of Southern Ontario, Quebec. But essentially quite a bit different in August than we saw in June and July of last year. Looking at this past winter, again, kind of a split look across the U.S. and Canada with the main warmth focused from the plains to the Rockies, extending into the Canadian Rockies. But we did see a pretty extended cold period for the eastern U.S. and eastern Canada, especially in January and early February. It was with Winter Storm Fern that came through the eastern U.S. and then the cold that followed that as well. When you look at the month-by-month breakdown, you can see December was cold, January was cold. We saw a little bit of moderation, kind of in that second, third week of February. We still ended up, on the cold side of things for the East. Whereas the West, other than, some early winter cold, saw a relatively mild winter, with Alberta sitting above normal both January and February. One thing to note as well is the pretty dry conditions that we saw this past winter, broadly across the U.S., but also the last 2 months of winter extending into Quebec. And, we did see some building drought conditions. We'll touch on that in a few slides from now. So let's talk about ENSO. Climate trends, sea surface temperatures. A lot of the reason we pay so much attention to this part of the forecast is because it is a big driver of the broader atmospheric pattern. From there, we can try to nail down details, but especially when you start to get into strong, strong teleconnections like El Nino and La Nina, that starts to increase your confidence levels on what you can expect going into a season. First, I want to talk about kind of a change in the way we look at things. This is being broadly adopted here in the U.S. From NOAA, the National Weather Service, and their seasonal forecasting. Traditionally, in the past, we've looked at something called the Oceanic Nino Index, and essentially this is a 3-month average sea surface temperature as compared to normal. So when you are negative 0.5 or lower, you are in La Nina. When you're positive 0.5 or higher, you're in El Nino, so warmer than normal sea surface temperatures over the equator. Well, as the climate has continued to trend to the warm side, we need to kind of look at it in a different lens. And so there's, we have an index now called the Relative Oceanic Nino Index. And this is an adjustment to the traditional ONI. Still uses the 3-month bucket, rolling 3-month average, still uses anomalies, but it adjusts for the effects of the changing climate trends, the overall warmer ocean system, and just it basically compares it relative to the rest of the ocean. And so the result is kind of a better, more accurate view on the impacts from ENSO, by removing those trends. Largest impacts, as you would expect, to the changes are kind of in that red box that I put on those two tables. It's the last 2 to 3 years. We've seen, like last winter, for example, the new RONI would classify it as a weak to moderate La Nina, while the old ONI would classify it as a weak La Nina or even negative neutral. 2023 summer, which was our last El Nino summer, would now be classified as a weak El Nino, whereas the old ONI would classify it as a moderate El Nino. So you could see a little bit of a step change in how we think about things. But the main takeaway is the impacts from El Nino, especially moderate to strong El Ninos or La Ninas, is not really that different, than what we've seen in the past. So where are we right now? These are the traditional, looks at the ENSO region. The image on the left-hand side is a top-down view. Just basically focusing right over the equator with South America on the right, Indonesia on the left. You could see some small cool pockets left, some small warm pockets appearing. It shows you that we're kind of in that transition period. You move 3 months from now, and I'll get into this in a couple of slides. You actually the next slide. You get into this 2 or 3 months from now, and a lot of that is going to be oranges and reds. The middle image is a time series that runs from 12 months ago on the top of the image to current on the bottom of the image, to just kind of show you the trends over the equator. You can see we've been in a pretty significant La Nina look, cooler than normal temperatures across the equator. But we're starting to see that fade a little bit with that warmth over by Indonesia starting to kind of spread its way eastward towards the main ENSO region. And then the image on the right-hand side, again, I always talk about this. I love looking at this subsurface temperatures. It's essentially if you would take a slice of the ocean right at the equator and look at it. At the top of that image is right at the sea surface. At the bottom of that image is around 450 meters in depth. This can show you, if there is warmer than normal water just lurking, just under the surface, then all it's going to take is a little bit of an upwelling event to rapidly accelerate into whatever phase you're looking at. On the flip side, it can do the opposite, right? If we were looking at El Nino at the surface and maybe there was some cooler water just under the surface, then maybe, we could say, well, El Nino, a little bit more of a question of where we're going this summer. But this gives me confidence that, with this warm water lurking just under the surface, that we will head towards that moderate to strong El Nino. And that really is agreeable with the latest model forecast as well. So these images, top left image is various ensemble models. Top right image is the Euro ensemble model look at ENSO. The bottom image is various dynamic and statistical models forecast. They all agree with each other and show a rapid move towards El Nino conditions soon, if not already, and pushing towards potentially record level El Nino by the time you get towards the fall, the autumn, and even winter months. If you're looking for previous recent El Nino summers, there's not a lot. You have to go back to 2023, as I mentioned earlier, 2015, 04, 02, and 1997. So there's really only 5 out of the last, nearly 30 years worth of summers that we've actually had an El Nino summer. And if you break it down even further than that, and you're looking at moderate to strong, as some of these models are suggesting, you've really only got 2. That's 2015 and that's 1997. I struggle really with looking past 2000 because the climate trends are so significant, but those are some of our analog years that we are using in our forecasts. The rest of the ocean system, again, I mentioned earlier, the big reason we use the relative ONI now is because it's so warm. You can see there's not a lot of blues showing up on that top image. But we still look at something called the negative PDO, which is the Pacific Decadal Oscillations, a measure of sea surface temperatures off western North America. You've got the positive AMO, which is, again, warmer leaning Atlantic waters. That's been going on for years and years. One note about the negative PDO, it's actually a measure, when it's in its negative phase, it's actually cooler than normal SSTs. But the last time we had a positive move towards the PDO was conveniently the last time we were in a strong El Nino. 2014 and 2016 we were in a positive PDO. So that kind of shows you that maybe the PDO is not much of it can be overpowered by a strong ENSO phase, and I think that's what we might see here. And really, it just you utilize it as an enhancer. If there's warm SSTs off the west coast of North America, it's very likely to sustain a ridge or warmer conditions out across the west coast. Climate trends, as I mentioned, so here's a quick view of U.S. Every summer, all of this is not new news, right? Every summer in the top 10 warmest has occurred since 2010. 17 of the top 20 have occurred, warmest have occurred in the 2000s. But the main takeaway from this, at least on a U.S. perspective, is 5 of the last 7 positive neutral or El Nino summers have fallen below that trend. So kind of indicating the support for maybe a cooler or not as hot summer across the US. For Canada, it's a little bit different. We're still seeing an increase in CDDs per year, similar to the U.S. Maybe not as strong in parts of Western Canada, and similar to some of the trends in the U.S. Recent El Nino summer trends show that 4 out of the last 6 ENSO positive summers have run under or cooler than the 2000s trends for the East. And have actually been some of the coolest summers of the 2000s. The West still staying on that warmer trend. So bottom line is, due to the expected strength of El Nino, and it's going to be the main focus this summer, kind of favors that cooler lean in the East and mixed to warmer in the West. Drought conditions, as I mentioned earlier, we have seen some relief across the entire country, but we're still dealing with some severe drought conditions across Quebec. We've seen some wetter conditions here over the last handful of weeks across southern Ontario, the Great Lakes region, so not as much of an issue there. We also have some drought conditions across the border regions of the West. So again, drought really is not a weather maker, it's a weather enhancer. So if we do get into a hotter regime, a warmer regime, drought conditions would serve to kind of enhance that heat, cause it to come in a little bit to the warmer side than expected. Quick view at climate models. I struggle with the recent climate models because they're based on the 30-year trend or 30-year normals. A lot of times they show a lot warmer, forecasts than what is expected. I think the ECMWF does a pretty good job at filtering that out, and you can see kind of what I talked about earlier on that far right-hand side, that image showing a little bit closer to normal. You can't really call it cool, but cool relative to the last 10 years for the East, whereas the West and the Rockies running much above normal. And then last but not least here, looking at the Environment Canada and the NOAA CPC forecasts, Environment Canada calling for pretty warm coast to coast. This is their probabilistic automated forecast. So I take it with a grain of salt. Don't really have a strong signal on the precip, which is that right-hand image. And then you can see the smaller inset images. That's from the U.S.'s NOAA CPC. They have more of that traditional El Nino look with near normal conditions in and around the Great Lakes. A little bit of heat on the East Coast due to that positive AMO. A little bit of stronger warmth from Texas up through the Rockies, and you can kind of make the the extrapolation of that warmth extending into the Canadian Rockies as well. So that's all I have for you today. I am going to pass it over to Josh.
All right, thank you, everyone. All right, so we're going to talk about the natural gas world. All right, we'll start off with a lower 48 update, and we'll dive right into impacts from the conflict in Iran. So overall, North American fundamentals, especially in summertime, are largely unaffected from what's happening in Iran here and the big energy crisis that we've seen in prices of both oil and LNG. So you can see here the top two charts. I've got my number 2 oil, TTF NYMEX, and I've got some Canadian points. So you've got your Iroquois, Dawn, AECO, right? And what you can see here is in the May contract, some significant moves up in price for both, your oil and LNG, whereas NYMEX actually fell off. And these other markers, the Canadian prices fell off, along with the prices in the NYMEX. And largely that's to do with just some bearish fundamentals as we kind of push through the end of or through April. So April prices dropped off just due to the fundamentals there. The reason why you're seeing an insulation in gas prices in the summertime is that all of our LNG capacity is basically already maxed out, and the impacts from direct switching of oil don't really happen unless it's in winter. All right, but now let's look at winter prices. So you could see here in the winter, NYMEX is not off by the same degree as summer. Obviously, there's still winter premium that's baked in there. Your Iroquois prices have actually increased by 10%, following in suite with some of more the markets in New York and New England, which rely heavily during peak demand. They need to switch to a different fuel source. So you're either going to LNG or heating oil in order to balance that. So you've seen a significant push up in the winter premiums following your number 2 oil and your TTF prices. So that ripple effect from New England, New York is being felt in some of the eastern Canadian markets. Dawn actually kind of fell off only 1% during this time frame. But it was like large, at the same time, the Iroquois prices have ramped up. So meanwhile, AECO is down a bit. So that's overall the biggest impact. Now, from an indirect standpoint, the higher WTI prices may offer some extra incentive for producers to go and maybe change some of their drilling plans for, the back half of the year. But as things stand now, the producers seem to be pretty disciplined. They already provided their guidance, and there may be some bottlenecks in, getting labor, equipment, et cetera, to really start to increase production. But there is a risk there here with, higher liquids and oil prices that you could see an increase in production. But we don't really see much of a risk on that until maybe the back half of the year. All right, so for lower 48 fundies, we're seeing largely pretty close to last year in regards to where we're going to be by the end of season. So it's still going to be more bearish than historical normal levels. We look to have a surplus condition by the end of the year. When you look at the different pieces that make this up, we're coming into 3.91 right now is kind of where our expectation is. This is changing on a day-to-day basis, but in regards to LNG feed gas, we do expect to see some increases here. Now, this slide was actually made before we got the recent update from Golden Pass that Train 2 was going to be delayed. We don't expect mechanical completion on Train 2 yet till the end of the year is the language they use in their most recent earnings call. So there's a bit of a delay there. So actually LNG feed gas is probably going to be a little bit underneath what we have in the slide here. Obviously a bit more of a bearish impact from that delay. Production, we think is going to remain quite strong. You've got a lot of different projects coming online, unlocking capacity in the Permian, upwards of 0.6 BCF a day, which should be actually sometime this month. You should start seeing flows there, and another 4 BCF a day in Q4, with potentially some gas coming online a little earlier than that to feed some of those expansions there. And on the power burn side, we do expect to see an increase in power burns as well. This is fueled by the cheap curve for NYMEX, really pushing in more gas versus coal, just based on economics. You're also seeing an increase due to data center growth and partially offset by increasing renewables. Now, the one other thing, just weather definitely plays a major risk here. Same with hurricanes in the season. As you just noted from, John's presentation here, it looks like, there could be some risk of maybe a little bit of hotter conditions across the lower 48 in the west and in the south, which could be, maybe a little bit supportive of demand. And also with this view of El Nino, it offers a little bit less risk on the Atlantic storms than traditionally speaking. Not saying there's none, but it's just versus normal conditions could be a little bit less there, which is also supportive. All right, so here's our chart on just kind of showing you guys visually what to expect here in regards to what's happening with data centers, and then also the increase in renewables, and then just some natural load growth. So really here, what you can see is that there is pretty much an offset right now, at least in the near term, of the increasing under construction and planned data centers and what the impact is there on a BCF per day basis. And that's pretty much offset by a lot of growth in renewables as well. So we're seeing, some offsetting impacts there. Meanwhile, just standard load growth is going to, increase the overall power demand for the grid heading forward. We also see, if you see in the bottom right chart here, this is your percentage of natural gas's share of the thermal stack. And what we can see is that this past month in April here, we were pushing upwards of, highs that we, to the high levels of what were previously observed there in 2024, I believe that is, upwards of 73%, which is very strong, 4% stronger than last year. And so far in May, we've seen a bit of a drop down to about 71%, but still, there's still quite a discount in the curve versus what we see for the coal to gas switching levels. So we expect some high utilization to continue to help fuel power burns even higher this year. All right, we're going to jump into the West now. All right, so starting with the West, we'll dive right into production. So Overall field receipts, we just model in a basic increase here at standard historical rates, coming in at 1.6% higher. So that's going to fuel us to about a 0.2 BCF summer over summer view. Keep in mind we also layer in the impacts from maintenance in AECO. So you could see that curve is a little bit choppy there. So that's what's happening there, and we're still coming to a bit of an increase. Of course, the stronger WTI prices may drive a little bit more production or just offer a little bit of further incentive there. But I'll get into some impacts on production later because there is quite a lot of other bearish fundamentals in the West that could be impacting AECO production. In regards to BC, the big increase was last year in anticipation of LNG Canada. So far this year, on a year-over-year basis, we're not really seeing too much of an increase, about 50 MMCF a day this quarter versus the past quarter, as LNG Canada is getting close to near max capacity. All right, so indirectly here, we have seen, potentially some of the impacts here in Iran and just, global affairs really pushing some more focus and government backing of LNG projects. We expect to have the target is 6.7 BCF a day by 2030, and there's a few big factors that the government has, stepped behind to really help push a lot of these LNG projects past the line from a regulatory standpoint. One of the pieces is the Major Projects Office. This was built to fast track approvals, and we've had specific designation of a couple of LNG projects in this Major Projects Office, and that includes LNG Canada Phase 2 and Port of Churchill upgrade. So we're actually seeing LNG projects, listed as a priority here. We also saw recently the government announced the Canada Strong Fund, which is a 25 billion sovereign fund, and this is going to help secure investment to really help these major infrastructure projects. So really there's a major political mandate right now that's basically behind energy security for Canada and export diversification. So overall, I would say the government landscape that had previously really delayed a lot of these LNG projects seems to be flipping around. So hopefully with this new approach, we get to see some increasing projects actually make it. All right, so of these projects, the one that is the kind of newest one that we've added here is the Churchill project. We don't have an exact BCF a day impact on this, but the in-service date is about 2030. If you back out the expectation of that 6.7 by 2030, we're getting to roughly 1.8 BCF is kind of what this Churchill project would need to be in order to satisfy that target. So that's how we come up with that. But outside of this, same sort of projects we had mentioned before, LNG Canada Phase 2, another 1.8 BCF a day. That's the other major project. We expect FID to come later this year, and we'll get a little bit more security on kind of what's happening on that project. All right, so here's our view on LNG Canada Phase 1. You can see it was a healthy ramp up in activity. It's hard to gauge the exact amount that's coming out of this because it is intra-provincial, and unless you're a subscriber here, you can't really see the amount going through there. However, we do back it out based on LNG ship traffic, and that's the blue line that you're seeing here. What is visible to us is the Sunset Creek nominations, the Willow Valley nominations, which you can see on the bottom there stacked. And that's, the gas coming in from Alberta and BC that helps to eventually get down to Coastal GasLink and feed the LNG Canada there. So basically, so far this last April, we're up to 1.6 BCF a day, which is near the cap at 1.8. So basically phase 1 is both trains are basically close to operating near max cap. Okay, so the LNG Canada price impact. We have seen a firming up of prices on BC to Alberta with this extra demand that's pushing to the province. However, more recently we've actually seen AECO basically remaining a premium over BC, while some days you have seen that spread reverse. We've tended to see AECO remain on top of BC. BC still remains a bit of an island, so other impacting fundamentals will still ultimately kind of control prices there. And basically, we've seen production increase in order to satisfy the LNG demand. So on a net basis, you're still looking fairly balanced there. And I would just say going forward here to expect a lot of volatility in regards to when, maintenance is coming into play, whether it's on the LNG side or whether it's on, your T-South pipe. Different impacting factors will ultimately drive a lot more volatility here, especially as further LNG increases. All right, in regards to Eastern exports for Alberta, we're looking pretty flat year on year. The same big maintenances that impacted your downstream deliveries to Great Lakes seem to be in play again this summer. So really the forecast there remains pretty flat year on year. We believe, your Empress volume should be pretty flat year on year as well, maybe slightly higher. All right, this is the big impact factor for AECO this year. What you can see here down on the bottom is that we have been hitting recent lows, almost like 5-year lows here. So we have been hitting 5-year lows here in April, down to 1.7 BCF a day through your Westgate, which is only 70% of the available cap. That's quite significant. What's been in play here is a very, very bearish West winter has left storage balances near 5-year highs, and you're seeing very low demand as well here through the shoulder season. So there really isn't a demand pull for the Alberta molecules. This is compressed spreads and basically made it uneconomic to flow gas down. Containment issues are a bit of a risk right now in your California markets, Pac Northwest as well. And not only that, we're also seeing Rockies gas now competing for market share of the West as well, pushing back on gas into Canada essentially. So you've lost a lot of export demand out West, and this impact looks to be something to continue through summer until we see incremental demand from the West or storage balances come back to within more normal levels. This could be an issue going forward that may have an impact on prices in order to basically force Alberta to balance here. So we could see some lower production driven from pressured prices. And here's what I'm talking about. So you can see the California market, just how much gas is still in storage. You're sitting near that 5-year high range in both your Southern California and your PGE storage, which is more your Northern California storage. And the bottom left chart there kind of goes to explain what happened. So the CDDs and the Gasway HDDs actually for the West came in significantly lower. In fact, the lowest we've seen in like 10 years. So with just that lack of winter, and the high storage levels that we actually came into winter with, we didn't withdraw enough. And even if you're looking at PG storage here, there was not much withdrawals at all. It just leaves us really, really with a lot of gas in the ground, and we have a whole summer worth of injections to try to cover here, right? So a lot of that gas is getting pushed back. Now, looking ahead, we do see bullish impact here is obviously weather. If weather is going to be hot, we could see potentially some stronger demands to help balance the situation. But we also see Energy Costa Azul, which is picking up. Now, that's a facility off the west coast of Mexico that looks to cannibalize supply from SoCal. The ISD was last reported as August, but we've already seen some small commissioning volumes delivered to that facility. And based on our recent comments that I actually just saw today, we could get gas flowing there and significant volumes flowing there as early as June. So that could help with some of the balances here as well, but we'll have to keep on monitoring that. All right, so with all that being said, AECO storage balances are already near those 5-year high levels. We're actually right flat next to last year's levels. So looks to be a similar type view as last year, except, quite a bit of bearish risks for the balance of summer with just this situation in the West and gas being pushed back into AECO. With this, we could see some significant, downward pressure on prices to incentivize some production shut-ins in order to keep storage from overfilling this summer. One piece to look out for, though, is the impact from Costa Azul and, of course, weather. All right, Eastern Canadian update. All right, so while the West looks a little bit, very well supplied, the East actually is in the opposite situation. We're below normal storage levels, and we had quite a cold winter in the East. Specifically to markets in New England, New York, that tend to pull a lot of gas from dawn during winter. So winter storage balances were below normal levels from dawn. And heading into April here, we actually saw a major maintenance on Nexus pipeline that impacted the amount of gas that could be delivered in April. So we couldn't really catch up storage volumes in April. You can see there down here on our vector pipe, a significant drop off in volumes here. And so that has since picked up because the maintenance is done. So we're going to see a big pickup here in storage injections in dawn come May. But besides that, we're still looking like we're going to be a little bit tighter year on year and playing catch up in storage for the balance of the year here. Now, one other thing to look out for is we do see quite a bit of nuclear units actually come back in July, which should help actually push down a bit of our demand for power. But then back in October here, we see some more units come off for refurbishment, which would then increase your demand for your gas demand for power generation starting in October and kind of pushing through winter. All right, so in regards to contracting, we're fairly flat year on year, a little bit more out of Empress. But outside of this, there's no real massive drivers, no big volume changes until winter 27-28. Dawn spreads remain supportive. And I believe we're still in the money for contracting once the new contracting becomes available. All right, so here's our dawn storage view. A tighter overall April has further widened the deficit, but injections so far in May, we'll see exactly how far they come in at. But from our view here is we think dawn's going to be playing catch up this year in storage. Do we think it'll still fill heading into winter? Yes, we absolutely do. But I just think that dawn is going to have to remain in a position to draw in molecules from the Midwest. So continue to price at, in a way that it's going to maintain flows from the Midwest into dawn to make sure that dawn does fill this summer. So I would expect to see some strength in dawn versus, Midwest throughout the remainder of summer. Especially fueled by the fact that the Great Lakes continues to have restrictions this year. So, all right, that wraps it up for my update. I'm going to pass along to Greg now to talk about power.
Hi, folks. This is Greg Garnsey. We're just having some technical difficulties with you being able to see the slides. So we're going to give this a try with the power traders, with Greg on our power trading team. So bear with us. And if we will have a copy of the presentation after to send around, so you'll be able to see the slides. So Greg, over to you, and let's see if you can get this working for us.
Just show. Okay, sorry. So we're going to have some. The browser's going to show up here, unfortunately, but we'll try to power through here. So Thanks, Josh. I'm Greg Billingsley. I'm the manager of the Canada Power Trading Desk here at NRG, and we're just going to take a look through some Alberta and Ontario power fundamentals. So we'll start with a quick look back at historical AESO pricing. Prices peaked in 2022 amid tight supply conditions and aggressive economic withholding from market participants, and following that, prices eased in the back half of 2024 as new thermal generation came online alongside continued renewable build-out. In 2025, the AESO recorded the lowest average prices of the past 5 years, and we're seeing that trend continue into Q1 2026, which settled $32 per megawatt hour, reflecting the current low price environment. So the first key fundamental here is the BC snowpack. Snowpack remains one of the strongest indicators of hydro supply heading into Q3 for Western markets. Relative to last year, BC snowpack conditions have improved materially. Under strong hydro conditions, BC is able to export power into Alberta, keeping all regional markets well supplied and generally reducing price volatility across neighboring jurisdictions. So historically, Alberta has been a net importer of power. In 2023, however, tight fundamentals in both Alberta and neighboring markets caused these power flows to flip between imports and exports in response to hourly price signals. Once we were in 2023, those hourly price signals, more often than not, led to exports going into mid-sea. By the back half of 2024, Alberta participants increased power exports during periods of high renewable output, which limits $0 hours and reduces overall price volatility. Going into the summer, we're just going to take a quick look at thermal availability. Thermal availability going into summer months is a critical fundamental. Year over year, overall thermal outages have decreased. Last year, Base Plant came online and was going through a commissioning phase, which led to higher levels of instability in their unit and led to prolonged periods where the unit was offline to undergo some maintenance. Towards the end of the year, it completed its commissioning phase and began delivering its full output to the grid, which added about 400 megawatts of incremental supply. This improvement materially strengthens the summer reliability. So taking a quick look at market power, this slide just shows the delta between actual settled prices and a cost normalized benchmark. This calculation is performed by the Market Surveillance Administrator and represents what prices would have settled if all participants offered strictly at variable cost. As new generation gets added, market concentration is diluted. This premium has declined over time. That said, the largest market participant in Alberta currently controls roughly 23% of dispatchable capacity, which does allow for meaningful influence over price when market conditions are tight. While we are in a low price environment, monthly volatility can still emerge just due to this concentration of megawatts among a small number of market participants. Alberta's current grid build-out includes a strong gas-fired stack of about 14 gigawatts, and about 10 of those gigawatts consists of cogeneration and combined cycle units that largely serve as baseload supply. Renewable capacity has grown to about 8 gigawatts, and in unconstrained scenarios can meet as much as 2/3 of Alberta's internal load. This high degree of intermittent generation contributes to volatility. This can include extended periods of $0 pricing during strong wind and solar output. And conversely, when renewable output is low, conditions can allow for economic withholding and higher realized prices in Alberta. So for congestion, we're just highlighting the impact of this continued renewable build-out that we've seen over the last 5 years and how congestion can impact some pricing. So duration curves on the left are showing curtailed megawatts in Q4 24 versus Q4 2025, and this shows a clear increase. On the right, we can see that in Q1 2026, the system has experienced nearly half of the total $0 hours recorded in all of 2025, and we're expecting this trend to persist into Q2 before tapering off in Q3 as summer heat will increase demand and limit some of those $0 hours. Okay, so for capacity build out here, we just have a snapshot of generation that's currently under construction in Alberta. This tends to be a bit of a longer term problem with most generation showing up in some of the outer years, but we have seen a significant number of projects drop off throughout the past year, but there still remains a sizable tranche of solar capacity, which is scheduled to hit the grid starting in late 2026 and continue through 2027. Incremental wind additions are relatively limited, with solar dominating the near-term build-out. It's also worth noting that some sizable gas-fired projects remain in the development queue, but they are at the pre-construction phase and are not included in this table right now. And most of those projects are starting in 2029 and later. So data center buildouts. Yeah, data centers have been a really hot topic across all North American markets, but as it pertains to Alberta, the AESO has outlined 2 phases for what they're calling their large load integration. Phase 1 allows for direct grid connection, which can be potentially paired with on-site generation, and those megawatts have been capped at 1.2 gigawatts of new load. Afterwards, we're going to enter phase 2A, which introduces a bring your own generation model for all loads looking to connect that exceeds 75 megawatts. But these won't be grid connected. These will be largely behind the fence and bringing their own generation with them. The phase 1 data center connections are expected to begin coming online as early as 2027, but there's some supply chain risk that may extend that. So as for the other AESO initiatives right now, the restructured energy market is always a hot ticket item these days. So right now it's currently targeted for an implementation in early 2028. The overall design remains largely unchanged from our last update, which includes an increase in the price cap to $1,500 per megawatt hour and revisions to the secondary offer caps, and is going to introduce an LMP framework for generators. Some of the additional initiatives include financial transmission rights, optimal transmission planning, and some transmission reinforcement payments. But the main update here was the start date is expected in 2028, where previously it was a mid-2027 start date that we were slated for. So with that, we will jump over to Ontario and look at some price trends. So this chart just shows the settled prices over the past 5 years. The Market Renewal Program, or MRP, went live in May of 2025, and to date has resulted in improved price fidelity and higher average commodity prices. Q1 2026 saw particularly strong settles driven by prolonged cold weather events across all eastern markets, which led to some competition for available megawatts on the physical interties. So for settled heat rates, the Ontario heat rates, which is just calculated as the power price divided by the gas price, were elevated last year for a couple reasons. First, MRP improved transparency, and second, nuclear capacity was constrained due to extensive refurbishment outages. We also did see some high levels of exports to neighboring jurisdictions, which contributed to tighter fundamentals and stronger realized heat rates. So historically, just going to take a look at some Quebec exports now. Historically, Quebec's strong hydro system has supported imports into Ontario during strong water years. However, in late 2023, we started to see some weaker hydro conditions, which reversed this dynamic, and Ontario started exporting power into Quebec. And this is also happening across some of the other eastern markets, like the New York ISO also supplies Quebec with power. So this tightening contributed to an elevated heat rate level and remains a potential source of upside risk for the summer. While hydro conditions have improved slightly, Quebec does remain quite dry overall, as John alluded to earlier. So now the big item in Ontario is also the some of these nuclear refurbishments that we're going through. So some of the key outages to highlight include Bruce G3 and Darlington Unit 4, which are currently offline, and they're scheduled to return to service at the end of July. So August and September should see some improved nuclear availability if all the refurbishments are cleaned up on time. However, heading into Q4, refurbishment activity ramps up with roughly 2 gigawatts going offline at the Pickering units, and additional 800 megawatts from Bruce G5, which can provide some potential upside risk to prices. So I'll just, this graph just summarizes it a little more clearly, exactly what we're expecting. So you can kind of see that dip as we approach August and September, and then the increase in all the outages right as we start October 1st. Things are looking to have a little less supply available in the ISO region. So lastly, we'll take a look at some longer term outlooks. And for this, we're referencing the ISO's capacity forecast. And so as this title suggests, energy needs are expected to materialize before capacity additions can hit the grid. So this also introduces upside price risk in some of the longer terms if incremental procurements don't currently keep pace with demand growth. So there are some long-term procurement plans for the ISO, with the first long-term RFP focusing on quick-to-build resources just to bridge these tightening supply cushions in some of the more near-term years, and then a second long-term RFP is using kind of an all of the above approach to meet some of the longer-term needs, which, you know, as you can see from the graph, is the ISO is very, very bullish their long-term energy outlook.
Hi, everyone. I'm Isaac Lurie, Manager of Strategic Client Services for Direct Energy. And what I'll be doing is try to connect some of the fundamentals you just heard into actionable strategies for your consideration in terms of managing your spend. So in terms of strategy consideration, this is just a recap of basically what we sort of discussed, looking at some of the key points. Canadian government intervention. This is new to Canada. Sovereign Wealth Fund, all brand new. Will this fast track some of these LNG projects? Phase 2 has already been announced and made the list by the major project office. So again, these are projects big in scale, and they're going to go forward with less impedance than ever, considering especially recent past. So expect those projects, expect that LNG export to kick up in short order. In terms of AECO, as Josh mentioned, record high storage levels. It's the winter that wasn't in western part of the continent, really. What that's done is it's left a lot of gas in the ground, creating a fairly bearish impact to the near term. But longer term, as you look out down the curve, LNG Canada hitting full stride. It did stumble out of the gate. Now we have Train 2 fully operational, so it's hitting its maximum ability to export. And so that's all going to as well kind of flip the script perhaps out in Western Canada as you look down the road. Dawn, again, Josh mentioned we've had some persistent pipeline outages over the last few years. That's limited flows into Dawn, and that's got some risk potential there, as well as the fact that it was cold in Ontario, and that left storage relatively depleted in terms of the continent. In terms of power, Greg kind of covered what some of this uncertainty around the REM or the redesigned electricity market in Alberta, and that rollout being delayed. There's been a lack of new generation buildouts, and of course, data center load growth is top of mind across most jurisdictions. In Ontario, in terms of power, we've seen elevated pricing, significant. The nuclear outages, that's kind of the biggest factor there, along with some capacity shortfalls in the long term, where the province is going to have to meet its growing demand and those diminished imports from Quebec. With the drought conditions persisting. The other key thing to Ontario, and I'll touch on it later as well, is the global adjustments actually turned negative. And so that's been sort of a 180 degree from historical price impacts. But looking kind of backwards, I guess, in terms of what happened during Storm Fern. This is the weather maps on the left-hand side, showing us those purple blobs settling in over the U.S. Midwest and Eastern Canada and Eastern Seaboard, the U.S. That was the forecast and weather outlook on January 22nd. You can see down below the heating season tracker that shows you the intensity, and that's for the winter to date at that time. And really, you can see on the price chart on the right-hand side, the spike at dawn that occurred. We hit 91.50. The same-day market actually hit over $200 for natural gas. So just to give you an example, a customer who was floating on index the first 22 days of January, it averaged 394. When you look at the back end of January or 18th to the 31st, that average jumps to 18.52. You average it all together, you're at $8.64, or nearly double or more than double or 120% increase. Now that's just using a straight average. If you actually heat shape adjusted that, in other words, when it's cold, you tend to burn more gas. If you're using it for space heating, that increase goes to $12 and the percentage goes to about 200%. So definitely riding the index has some consequence, especially when you have extreme winter events. And so, how do you kind of protect yourself from some of these extreme winter events is really, considering a diversified strategy. If you look at the risk product spectrum on the right-hand side, index, that is, the choice to be taking the market price as given, you will be subject to these price spikes. So you've got the unlimited risk and opportunity. In other words, you may pay the least or you may pay the most on those sorts of products. And that's very analogous to buying a stock portfolio of one stock and putting all your eggs into one basket and having sort of that stock dictate for you your returns. What we offer as well, Direct Energy, is a managed and layered approach, which combines balance and control and allows you to spread your risk over multiple layers and be a little more strategic in your purchases. What that does is enables you to dollar cost average and spread that execution risk across multiple timeframes and use the best fundamentals available in order to procure your supply. And then the end of the spectrum, really fixed price. That's kind of when you set it and forget it. You just want one fixed price for whatever you consume. That's also, an option. But using the managed approach, sampled down below, you can see fixing something like 50% of your load and looking for opportunities to hedge into the future as a more intelligent approach is something we suggest. Move forward. And so this is sort of the idea behind hedging. Well, what do we talk hedging? What do we mean? Again, that index piece where you're taking the market price and you think back to this winter, that's really that shaded area in behind where you see on the x-axis is your spend distribution and your probability on the y. And you can see how wide that distribution is, where those outcomes are really wide. And then if you think of a 95% confidence interval, bringing those goalposts in, that's what a 50% hedge profile would look like. And that's the orange, more peaky distribution. But again, both cases, your expected spend is right at that zero zone, or that F is the same no matter which outcome. It's just where those outcomes land and narrowing those goalposts is sort of the idea to provide you with some budget stability in terms of your spend and be able to do some planning moving forward. Next slide, thanks. And then so combining that sort of construct in terms of what are you trying to achieve with hedging, what spikes can occur, and then what does this look like go forward? And so this is a percentile analysis looking at the major markets in Canada. We've got power on the left-hand side, gas on the right. Alberta's at the top row and Ontario below. If you look at the power percentile there, you see those gray bars every single month. That's the price that the power has transacted in for any given month. And the blue dash, that represents where the current price is. And you can see, those blue dashes very much near the low end of the range. So we're pretty much near the lowest price point historically over the last 3 years. And that actually rings true both for power and for natural gas. You'll see that in Alberta. So when we see these opportunities in terms of those blue dashes being near that low end, we know that, historically speaking, you've got some opportunities to take some risk off your table. If you look at Ontario down below, it's a little different story, particularly on the bottom left where we have power ranging from kind of mid percentile level to the high percentile levels as you march out the curve, representing sort of the uncertainty that we see in Ontario in terms of the power price. So definitely a different story there. And then the gas price Ontario being the final right-hand slide, Dawn having some very good opportunities in the near term for hedging out to 27 and steadily increasing into sort of the mid percentile. So moving from about 10 percentile, in other words, being lower than a price being lower by 10% of the time in calendar 2027. By the time you hit 28, you're closer to 40%. So definitely some near-term buying opportunities in those terms. And so we use these examples to sort of help formulate, where is the price lower? How can you hedge, in advantageous scenarios, especially facing these contango type markets. Go ahead and next slide. And so in Ontario, that price being elevated, what that's left is sort of creating a pretty interesting situation in terms of the global adjustment. Now, this heat map shows you the global adjustment rates. If we go back in history, they were quite high, over $100 a megawatt hour. And you can see Q1 and even December going negative this winter with some really high and price power and winter events. So when you plot the power and the global adjustment rates on the right-hand side, you see that they're very much inversely related. And global adjustment is a payment guarantee to various generators, based on the difference between their struck costs under those contracts and the market rate. So it's expected to go negative in times of high prices. So this is very much a changing dynamic for Ontario. And just a reminder for those that chose to hedge, not only, when you're in a lower price environment, when you choose to hedge your commodity, you also can win on your global adjustment should the price increase. So you sort of have two methods to generate value from hedging in Ontario. Go to the next slide. And just to wrap up, fundamentals for gas are very bearish. We've seen, some weak weather, particularly in the West, leading to some very good pricing opportunities. In terms of power, Alberta, again, near historical lows. And in Ontario, you see the price, again, with those nuke outages and sort of that renewed market, some going through continual growing pains in the near term. So again, really, just to wrap up, the point is to have an actionable strategy, look at your risk tolerance and goals, balance off the need for budget certainty versus driving to lowest cost, and really be ready to transact as the market really does not sort of wait for buy-in and approval from stakeholders. Thanks, Craig. And with that, I'll hand it back over to you for closing comments.
Thank you. Thank you, Isaac. And unfortunately, we've had some technical difficulties today, so apologies for that, everyone. And thank you for listening if you managed to stay on here. We will send the presentation link to folks so they can watch that and be able to see the slides. And we do have a few questions which we're going to answer directly because we're over time here by a couple minutes. So we will send those out to the folks. But one of them was just, how do I get plugged into the market updates? And you can just check in with your account executive and they can plug you into the regional market intel and the resources we have. So please check that out. You should see the poll on your screen now. And if you could just give us some feedback, that'd be wonderful. That's all we have time for today. So thank you to our speakers, John, Isaac, Josh, and Greg. As I said, following today's webinar, you'll receive an email link that will provide you with the deck and some questions. So please follow up on that. And thank you, everyone, and have a great rest of your day.